The way that this rental property is set up on a 30-year loan, to pay this loan down by $3,988.21, doing it the bank's way, you would also have to pay them $46,416.20 in interest. I'm so glad that you asked that, because most people don't see this. Because if they're making money on their rental property, listen, I get the rent, I pay the mortgages, I keep the difference. We're making money, correct? Is that how we look at it, Ms. Villa?
That's correct.
Okay. So if we're looking at it that way, we're not paying attention to how much interest we're actually paying to cash flow that kind of money. But what if we paid attention to that as well? We could save a lot of additional monies in interest that we count as paying that money as the cost of doing business. You do not have to pay all of that interest. Now, why is that so important? We're going to take a look at mortgage number 9. We're going to go into accounts and take a look at mortgage number 9. I'm going to show you some insights to this. And so once we go down there, we're going to find mortgage number 9. Okay, that's number 1, 2, 3, 4, 5, 6, 7, 8, 9. Here it is. Mortgage number 9. We're going to open it up and take a look at that. Mortgage number 9. We owe $487,000 at 6.5% interest rate. Okay, $487,000 at 6.5 interest rate. So I want to show you something right here. We're going to go to this 487,000. We're going to put that in, okay, at 6.5 interest rate, 30 years. We're going to come up with the same payment, $3,078.17. On the very first payment, watch this. Look how much goes to principal, $440.25. Look how much goes to interest, $2,637.92. In the very first year, this mortgage, if we pay it down the way the bank says, making your minimum payment for 1 year, you will pay this mortgage down by $5,443.33, and you'll pay $31,494.71 in interest.
Have mercy. Have mercy.
This is a real estate investor that's making plenty of money, because on the rent that they're charging on this is more than the payment for the mortgage. Okay? So this is a multifamily building here. So they're charging a lot more than the $3,000, and they're making money. But what they're not looking at is, I just paid out in the first year, I just paid out like almost $37,000 paid out in the first year just to get $5,400 in equity. So
Wow.
if we prepay this $5,000, we don't have to pay the 31 grand that goes along with it. Come on, real estate investors. It's time for us to stop leaving money on the table. So when we go back to the program, All right, back to the program. We're looking at making that very first payment, going back to the action plan. I got 2 things to show you here. We're going back to the action plan to see again how much the program says to prepay. When we prepay on that, $3,988.21, we're going to save 46 grand in interest. That is what we're talking about. And I just showed you on an amortization schedule why that is true.
Wow. Okay.
Okay. So yes, if you're a real estate investor, now here's what I tell most real estate investors: where are we going to get that money down? Because I want to take the money that I'm making and I want to invest it in other properties. I don't want to use it to pay down the loans. And I'm saying, please don't do that. Don't use that money you need to invest to pay down the loan. If you're a real estate investor, you keep a little cash in reserve just in case something goes wrong. Correct, Ms. Villa?
That's correct.
So I have a real estate investor that has about 60 grand because of all the properties that they have. They have about 60 grand in reserve. I said, in this case, could we, out of your 60 grand, could we borrow $3,988.21 out of the 60 grand you have sitting in the bank in reserve, making 1/10 of 1% in a savings account? 1/10 of 1%. Okay. Take $39.88 out of that savings account, pay it. We're advancing it to the mortgage because it's not new money, it's the same money. Advance it to the mortgage, and then over the next 2 or 3 months, pay yourself back the $4,000 that you would normally put into the reserve fund anyway. After you pay
Okay.
yourself back after about 4 months, could you do it again, Miss Via?
Yes.
And then again, and then again. And so we're killing all these mortgages, saving hundreds of thousands, millions of dollars in interest in this case. And we'll be able to buy all of these properties. So we're going to say $1,446,339 less we have to pay. Because here's what you need to know. When you borrow money to pay for a house, it is not just the house you're paying for. It is the interest on the money you buy the house with. So you have to total the amount here. Okay. All right. So on the total amount on this one, on $487,000, the bank wants $621,141.20 in interest on a $487,000 loan. That means the bank wants way more in interest than you borrowed in principal. So your total interest paid as a percentage of principal, 127.544%. That part. That's what we're avoiding here. So folks, going into this next year, all of this started in 1934. Going into this next year, this system of paying back loans will be 88 years old. 88 years old. And for 88 years, my father didn't know, his father didn't know, his father didn't know how all of this works. So how could we have passed it down? How could we have passed that information down when nobody knows?
That's right.
This is why we are here, so that we can break an 88-year-old curse of financial violence by the new financial literacy. Let's get out of the financial matrix, the money matrix, take the red pill. Let's see how deep this rabbit hole goes. Are you ready?
Yep.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.